Welcome to today's webinar. My name is Jason Q. I'm the managing attorney for nonprofit and small business legal assistance programs here at the DC Bar Pro Bono Center. A few little housekeeping notes just off the bat. For those listening live, if you'd like a copy of today's slide presentation, if you go to the handouts tab in your GoToWebinar platform and click the little white arrow to drop down the menu, you can see a PDF version of the slides that you can download and save to your computer. While you're there on the GoToWebinar panel, you'll also see a questions field. This is your opportunity to type in questions during the presentation. I will take a look at the questions at the end of each section of today's presentation and try to get to as many as we can. Today's webinar is being recorded, and so everyone will get a copy of the recording after the presentation, especially for the folks listening live. If we go over the hour that we have scheduled and you need to log off, know that you'll get the recording, so you'll be able to catch up. Let me think. I think that's all that I want to say up top. Again, welcome. Let me tell you a little bit more about our organization, the DC Bar Pro Bono Center, before we start. We are a legal services organization here in the district, and we have a nonprofit legal assistance program that hosts virtual and in-person legal clinics to address specific legal issues. We sponsor trainings, webinars, and podcasts on important real-world legal issues facing nonprofits, like today's presentation. We have written resources and archived training sessions and webinars on our website. And for the DC serving organizations on the line, we also match nonprofit organizations with volunteer pro bono legal counsel to help with larger, discrete legal projects or matters. They can help on a variety of matters, including corporate governance, IRS compliance, employment law, and real estate matters. So that's kind of an overview of what we do at the nonprofit legal assistance program here at the DC Bar Pro Bono Center. All right, let me give you an overview of today's webinar. So the scope is that we're going to be talking about legal compliance requirements that are unique to 501c3 public charities. What that means is that we will not be discussing sort of general business law topics like employment law, payroll issues, contracting, intellectual property, insurance. These are all important legal issues. Actually, employment law is the thing that I get asked most about in my job at the Pro Bono Center. But they are not unique to 501 public charities. They're not unique to the nonprofit legal world. So we're not going to be focusing on those issues. Nonetheless, we have a lot to cover. This is going to be a very high-level overview of 24 topics. Each topic we talk about today could probably be its own webinar. I'm going to have about 2 minutes to touch on each of them. So think of today's presentation as more of like an index or a checklist of topics that you might want to flag for future reading or future discussion. For a lot of the topics, I have additional resources linked on the slides themselves. So when you download your copy of the slides, you'll see hyperlinks going out to additional resources and follow-up resources. So we'll get you started. But if you walk away from today's presentation with more questions than answers, that's good actually. That means that we flagged things for you to think about and for you to dig deeper into. So don't worry about that. Also, this is usually where I would do my disclaimer that today's presentation is for educational purposes only. It shouldn't be perceived as legal advice. You should consult a lawyer if you have specific legal questions for your organization. That's even more true for today's presentation because even the educational content is so high level and so general. You're really going to want to dig deeper if you want to learn more about any of the specific topics that we talk about today. The audience that we're talking to today, it's officers, directors, staff, and other leaders of DC-based nonprofits that already have their 501c3 determination letter from the IRS. So I will not be talking about the process to get 501c3 status. And it's for folks who want to become familiar with ongoing nonprofit legal compliance requirements. Now, there is some DC-specific content in this presentation. We are a DC-based organization, but most of the presentation focuses on federal IRS requirements. So those will be relevant to non-DC based organizations as well. You're just going to need to check with local experts or local resources for any state law requirements. Let me give you an outline of the 24 topics that we'll be talking about. It's organized into 3 general sections. The first one is about following the money. It's about generating and using charitable funds. This is where the meat of a lot of IRS compliance lies. So we'll be going deep into those topics. Then we'll have a second topic on governance and operational requirements. And then finally, we'll close out with some filing and registration requirements, a bit of a drier section to kind of close out. So that's what we're going to be covering today. Let's get into it then. Let's start with section 1, generating and using charitable funds. Because nonprofit organizations are tax-exempt organizations, we enjoy a lot of tax benefits in the nonprofit world. We don't pay income tax at the federal level and usually at the state level. And donations to our organizations are tax exempt for the donors. So because we enjoy this special space in the tax world, the IRS and state regulators impose a lot of specific requirements on how we generate and use our money. And that's what this first section is going to be all about. The big concept in this, our first topic, is about avoiding private benefit and private inurement. Let me define those 2 terms for you. 501c3s are supposed to be operated exclusively in the public interest to pursue their charitable mission. The flip side of that is that they must not be organized or operated for the benefit of private interests. Everyone asks when I say this, well, what about paying people salaries to work at your nonprofit? Paying people money in return for labor, that's a business expense that is not benefiting a private interest in the way that we're talking about. But other kinds of enrichment can, and operating for a private benefit instead of a public benefit can result in a loss of your nonprofit status. A really quick story that exemplifies this that I think is so interesting. In the 1970s, there was a nonprofit that was formed to support classical music in a local community. And in that community, there was one for-profit classic music radio station. So in pursuing their mission, a lot of the nonprofit's work had to do with like encouraging people to listen to the radio station, encouraging people to subscribe to the radio station. The IRS determined that because so much of this nonprofit's work was about holding up this for-profit radio station, and it did end up raising the revenues of that radio station, that it failed the private benefit test. Too much of that nonprofit's work was serving a private interest instead of the public interest. The second concept here is private inurement, and really this is the one that comes up more often, is more of a day-to-day consideration for nonprofits. Private inurement happens when insiders of a nonprofit, we're talking directors, officers, key employees, receive financial benefits or assets from the nonprofit. For example, if the nonprofit just pays them dividends, directly gives them money. If a nonprofit provides them with perks, one example that I came across recently was a nonprofit that was paying the entire telephone bill for all of their directors. Even if a lot of those bills were not related to the director's work for the nonprofit, that's an excessive perk. It's also when nonprofits provide unreasonable or excessive compensation to their insiders for labor or products or services. This is what we call an excess benefit transaction. So if we overpay a director for a product that they provide to the nonprofit, and we'll get into these examples later. And then finally, the other example in this category is when we transfer property to insiders for less than fair market value. If our nonprofit owns a commercial space and we decide as sort of a favor to lease part of that space to one of our directors to run their separate business, and we charge them like a really, really beneficial rate, the low market rate, that is that kind of reverse excess benefit transaction where we're giving them something for less than the fair market value. All of these forms of private inurement are strictly prohibited. They can result in excise taxes, basically penalty taxes on the beneficiary of private inurement, and also on the other insiders at the nonprofit who approved the private inurement. At the end of the day, if it's egregious, it can also result in the loss of your nonprofit status. Topic B kind of flows directly from that private inurement conversation, and it's about navigating conflicts of interest. So a conflict of interest arises when a nonprofit insider stands to benefit personally from a decision that he or she has influence over, with respect to the use of nonprofit funds or assets. So the most common form of this is a transaction between a nonprofit and the insider themselves, or the nonprofit and an entity that the insider controls or has a family relationship with. An easy example is, let's say you're one of those nonprofits where your executive director is also a director on your board. That executive director cannot vote on their own compensation, because that is how much they get paid in their staff position is a transaction between the nonprofit and themselves, and they have a conflict of interest when they vote on that salary level. In that second category, if we have someone on the board who, let's say, owns a publishing company, and the nonprofit has to do some publishing and is considering using that director's publishing company for that as the vendor, for that work, that is a potential conflict of interest. Now, conflicts of interest are not inherently illegal or unethical, especially in that second category, but they can result in private inurement if they're not properly managed or controlled. So we need a process to navigate a conflict of interest. Essentially, that process first means excluding the conflicted director or individual from the decision-making process, literally making them leave the room, and then letting the disinterested directors that remain evaluate the transaction against alternatives that don't involve the conflict, and deciding based on that analysis if going with the conflicted party still serves the best interests of the nonprofit. Going back to that publishing example, if the director who owns the publishing company, if that company is giving us the very best rate for the very best service, we're allowed to go with that option. But we just need to analyze the alternatives and decide that it's still the best decision for the organization, and the conflicted director cannot play a part in any of that analysis or deliberation or decision making. This is the first example where we have some great legal alerts and webinars related to conflict of interest and conflict of interest policies, which are written policies that create kind of a roadmap for how your nonprofit will navigate these issues. All right, let me go to the third topic now. Again, related, it's about setting executive compensation. The IRS is really sensitive to how much we pay top executives at our nonprofits, and that's because historically, overpaying our chief executives has been an easy way of committing private inurement. So, if a reasonable salary in our market is $100,000, but we really like XYZ executive director, they're on our board, maybe they're the founder of the organization, and as a sort of a sweetheart deal, we want to give them $200,000. That overpayment above the market rate is a form of excess benefit transaction and a form of private inurement. The IRS has enumerated kind of a safe harbor process that nonprofits can use when they're setting compensation. Essentially, it means creating a disinterested, conflict-free entity or body within your organization that sets the compensation, and that does it using objective comparator data from peer organizations and comparable salaries in your labor market. So we have, again, a legal alert on setting executive compensation that you can check out. Okay, continuing on, we're pushing along. Let's go to topic D, which is acknowledging charitable donations. So when donors give money to your organization, they need an acknowledgement letter from the nonprofit in order to claim a tax deduction for cash donations over $250. Even if it's under $250, it's useful for them to have an acknowledgement letter from the nonprofit. Your acknowledgement letters should contain some basic information about who you are, how much money was contributed, and importantly, a description and a good faith estimate of the value of goods or services that might have been provided in return for the contribution. For example, if the contribution was in the form of a ticket to a fundraising gala and the gala included a dinner, you should include a good faith estimate of the value of that dinner as a component of, let's say, the $100 that they gave to attend the gala. That last example is really critical. You should always provide an acknowledgement letter in the case of what we call quid pro quo transactions, because donors can only legally deduct the gift value of their donation. So if it was a $100 gala ticket, there's a $20 dinner, they can only deduct the $80 that they actually gave minus the amount of the quid pro quo benefit that they received. It's legally required that you give acknowledgement letters for any quid pro quo transaction over $75. In the case of non-cash contributions, you can still give a nonprofit acknowledgement letter similar to above, but instead of saying the dollar amount of the contribution, you just give a description of the non-cash donations that you received. If it was like computers or furniture or something, just describe what you got. Do not assign the cash value yourself. That's the donor's obligation to do. You as the nonprofit recipient do not need to tell the IRS how much that donation was worth. Again, we have a great legal alert on acknowledging charitable contributions. Okay, keeping on with our financial theme, I want to touch on managing restricted funds. When donors and grant makers give you donations, they can add restrictions to their gifts, which restricts their use for a specific program or specific purpose. So, you know, this donation is only supposed to be used for XYZ program, or this donation goes into your endowment and cannot be tapped for programs or operation, for example. Restrictions can also arise when nonprofits explicitly fundraise for a specific limited purpose and donors give in light of that restriction. So if your nonprofit does a capital campaign and the whole purpose of the campaign is to buy a building, then the donations to that campaign might be restricted to that building purpose. Donor restrictions are important. They're legally binding and they're legally enforceable. So if you accept a gift with donor restrictions, really be prepared to honor the restriction. This can create a lot of new accounting complexities to properly segregate your restricted versus unrestricted funds and to make sure that you're not inappropriately spending the restricted funds. And it should make you consider important questions regarding the scope of the restrictions, whether they're time limited, what happens in cases where the restrictions are frustrated. So for example, if we have a restricted fund that's supposed to be used for the upkeep of XYZ community center at the intersection of W Street and U Street. If that community center is moved, or if that area gets rezoned or something, and for some reason we can't maintain that specific community center, how can we use those restricted funds? Are the funds locked into that specific address, or can we use them in a different building? And then finally, can we use the restricted funds for overhead? There's a lot of questions that come with restricted funds. Don't have time to go into all of them, but if you're accepting restricted monies, just know that that's an important endeavor, and to consult with legal and possibly financial experts to make sure that you're accounting for everything correctly and complying with the restrictions. My big tip with all this is to avoid restrictions whenever possible by communicating clearly with your donors, especially when you're fundraising with reference to specific projects. You know, if I have an animal welfare nonprofit and one year I decide my priority is saving the bees, so all of my fundraising materials like, give us money, help us save the bees, I might want to include a little disclaimer on those materials that when you give us money, or we might use it to save the bees, but really it's going to go into our general funds, and next year if we want to save the bears, we can use the money to save the bears as well. Something I want to touch on quickly is on the use of professional fundraisers. So these are third-party fundraisers that you pay to help you raise money. I'm not talking about your in-house development or fundraising staff. I'm talking about third-party, people that we go to. It's fine to use these professionals, but I just wanted to flag that doing so often creates additional legal ramifications. This is a highly regulated area, perhaps more regulated than people would expect. So some states require professional fundraisers to register with the state and obtain a license, and in those states you should be only using licensed fundraisers. Some states require a written agreement between your nonprofit and your professional fundraisers, and they might even require you to have specific language in those contracts. And in some states, using professional fundraisers triggers additional reporting requirements. There's also some reporting requirements on the IRS Form 990 if you use a lot of professional fundraisers. So just something I want to flag. And next I want to talk about, still in this fundraising space, the concept of unrelated business income. So nonprofits are able to generate their own revenue, and a lot of nonprofits do generate their own revenue as a critical component of their business model. There are two types of self-generated revenue. There's what we can call program service or program related or exempt purpose related income. This is income where the income generating activity itself contributes to advancing the nonprofit's mission. It's not simply that you're making money and then investing money in the mission. The activity that you do that generates the income also advances your mission. So, if I have a nonprofit museum, but it sells art books that are related to its feature exhibition, that's an example. A nonprofit dance academy that charges a fee for its dance classes, a nonprofit hospital that bills for its hospital services. In all these examples, the thing that we're charging for is also the thing that advances our nonprofit mission, usually an educational mission or maybe some other kind of service. The great thing about program service income is that it's unrestricted and it's not subject to income tax. The money that you make that's program related is treated almost the same as like a donation from an outside source. The other kind of self-generated income is unrelated business income. This is income from a regular trade or business that is not substantially related to advancing your nonprofit's mission. Examples might be selling gifts or commercial goods, selling ads, leasing facilities or other assets for non-mission related purposes. I have a lot of mission-focused nonprofits that want to sell T-shirts or tote bags or swag with their logo on it. Selling a T-shirt is not your mission, right? It like doesn't advance your mission. I mean, it gets your name out there and you make money, but really that's not your charitable mission, is to provide people with T-shirts that they pay for. So that kind of business, it can result in unrelated business income. The income that you get from unrelated business is subject to corporate income tax, a tax that we call UBIT, or unrelated business income tax. And it can jeopardize your nonprofit status if engaging in business activities eclipses your charitable activities or forms a substantial part of your operations. The idea here is that as a nonprofit, you're tax exempt. You shouldn't be competing with other for-profit businesses in what are essentially commercial endeavors. So nonprofits can do a little bit of unrelated business. They have to pay taxes on it, but don't let that become the primary or a substantial part of what your nonprofit does. We have a great legal alert on unrelated business income as well. This is our next topic. I think it's our second to last topic in this section. It's about maintaining public charity status. It's a little esoteric. Let me try to approach it as simply as possible. 501c3 organizations come in sort of two flavors. There are public charities and there are private foundations. I'm guessing that everyone on the line today and everyone listening to this is a public charity. Public charities are the most common 501c3 entity, and they are funded by a diverse mix of public sources, whereas private foundations are largely funded by a family or another small group of individuals or a trust or some corporations. So because private foundations have less public involvement and engagement and scrutiny, they're subject to additional operational and reporting requirements. Generally speaking, you don't want to be a private foundation if you don't have to. The preferred form is usually a public charity. Now, when you did your 1023 application, you opted into being classified as a public charity, and you told the IRS that you were going to be funded by a diverse mix of public sources. And what that means, in a really simplistic way again, is that at least 1/3 of your fundraising mix every year, especially over a 4-year period, will consist of either small donations, grants from other public charities, your program-related self-generated income, and or government money. So all of those different sources combined together will form at least 1/3 of your overall fundraising mix. In other words, you should be careful and seek counsel if your fundraising mix becomes dominated by one or a handful of large private sources or unrelated business income. And this happens more often than you think. Nonprofits start, they think we're going to fundraise, it's going to be great. And then you find like a couple of sort of like angel funders who just give you a ton of money every year, and they're like funding like 80% of your operations. I mean, that's great in a way. It gives you a lot of financial stability. But if they're really dominating your fundraising mix, it can jeopardize your public charity status over time. and it can reclassify you as a private foundation, which again means that there's going to be new operational and reporting requirements. You're going to have to file different 990s. It's a whole thing. So something just to keep in the back of your mind. Look at the diversity of your fundraising mix and know to be careful if those large private donors are beginning to form, around 2/3, more than 2/3 of your overall fundraising mix. Okay, and this is our last topic in the financial section. Then I'll take a peek at the questions that I know we have coming in. I want to talk quickly about audit and financial review. So let me define what we're talking about. A CPA financial review is when you hire a CPA to do an independent analysis of your financial records to see if there are any misstatements, mistakes, deviations from accounting principles. Basically, we're looking at your financial statements kind of on paper and making sure everything makes sense, making sure everything adds up. An independent audit is more comprehensive. It's a more in-depth analysis and investigation into those financial records, but also your actual financial practices. And it will usually include some testing of the underlying financial data. So we're not just taking the financial statements at face value, we're digging deeper and making sure that the underlying practices and the financial data is sound. There is no IRS federal requirement to obtain either CPA reviews or audits, but there are numerous other places that requirements can flow from. So your foundation funders or grant makers might require you to get reviews or audits. State and federal government funders might require you to get states or audits. At the federal level, for example, if you expend more than $750,000 in federal funds in 1 year, you have to get an audit. And then importantly, many states, around 26, require you to get either a CPA review or an audit after a certain threshold of fundraising in order to get a charitable solicitation license to fundraise in that state. We'll talk about charitable solicitation licenses down the road, but basically it's a license that you get to have permission to fundraise in a state, and many states attach CPA review or audit requirements to those licenses. For example, here in DC, we don't have a CPA review or audit requirement, but in neighboring Maryland, you're required to get a CPA review after you make $300,000 and an audit at $750,000 in order to get the charitable solicitation license in Maryland. Other states have CPA review requirements kicking in as low as $200,000. So there are some legal requirements here. Just stepping back a little bit from the law, using CPAs and auditors is also a sort of eat your vegetables kind of practice for nonprofits. It can be very, very helpful and just a good practice to do, notwithstanding whether you're legally required to do it or not. Okay, so I think that's the end of this first section. Let me take a quick glance and see if there are any questions that that makes sense to talk about now. If I can't get to your questions during the presentation, my contact info is going to be at the end, and we can talk offline. Yeah, okay, so I think a lot of these questions are a little bit more specific than I'm going to be able to get to at this point of the presentation, and a couple of them touch on topics that we're going to talk about later in the presentation. So let me keep on moving, and then we'll circle back to some of those questions at the end of the next section or at the end of the presentation. Okay, so let's get to section 2. We're moving beyond the financial issues, and we're going to get to governance and operational requirements. This is sort of our day-to-day functional stuff. Okay, so let's talk about sort of the first biggest high-level requirement. It's our adherence to our nonprofit mission. So my point here is that when you applied for 501c3 status, you told the IRS that you were going to have a specific mission and some core activities. So that's sort of why you got your C3 status. That's what your approval is based on. It's okay for your mission and your activities to evolve over time, but if they do, be sure that your new activities are consistent with what's required for 501c3 organizations and that they avoid, for example, that private benefit rule. B, that you update your governing documents accordingly to reflect your new mission and activities. I'm talking specifically about your articles of incorporation and your bylaws. And C, you should inform the IRS on your Form 990 that you file every year that you've made major changes to your mission and activities. That's how you give the IRS an opportunity to keep an eye on what you're doing and make sure that in its perspective, in its opinion, you're still complying with the law. Okay, that's pretty general. Let me talk about some more specific operational stuff. For those of you who run organizations that give grants to individual people or non-exempt entities, a lot to think about here. I'm not talking about giving money to other 501c3 organizations. Nonprofits, giving money to other nonprofits, pretty safe, not a huge enforcement priority, but granting money or resources to individual people or non-exempt entities does trigger additional oversight obligations. When you do these sort of grant programs, at the end of the day, they should further your own nonprofit purpose. The grants should abide by all 501c3 rules, including the prohibitions on private benefit and a prohibition we'll talk about in a second on political intervention. And you should be monitoring and controlling those grants very closely. So you'll do this under 990, for example. The IRS will make you describe your grant program, but you're gonna have to answer questions like, who's your charitable class? How do we determine who needs this support in a way that advances our mission? What are our selection criteria? How do we ensure that the money is spent consistent with 501c3 rules and our charitable mission? And I like to think of this as both like a front end and back end problem. So on the front end, when we're giving people money, we're gonna wanna limit the use of that money to a specific purpose that advances our charitable mission. You know, if it's providing food for needy individuals who have food insecurity, we want to make sure the money's spent on food. Maybe we do that by making it a gift card, you know, to a grocery store instead of just a cash transfer, or just making people promise that they're going to spend it on food. And then there's a back end control as well, which is to ask for reports or receipts to confirm that the money is used appropriately. We don't want to give money to people for food insecurity and have them spend it on something totally different that isn't consistent with our nonprofit's mission, and that might even violate what the law says nonprofits are allowed to spend money on. As we're going through this grant making process, we have to ensure that there are no conflicts of interest between the people giving the money and the people receiving the money. So, you know, the committee or staff or whoever in your organization decides on who receives the grants, they should not be grant recipients, or they shouldn't be related to people who are grant recipients. And more specific requirements to apply in some circumstances, like what we're talking about scholarships. Can't get into it all, but something to think about. Our next topic is closely related, and it's grants to foreign entities. So it's all the same stuff we talked about before when it comes to domestic organizations. It's even more onerous and requires more oversight from you if you're giving money to foreign entities overseas. The IRS is going to want to hear about how you conduct due diligence, or what they might call pre-grant inquiries. So how do you ensure that your foreign recipients qualify for assistance? How do we make sure that they're legitimate, competent entities? For example, do we make sure that they're basically the equivalent of a 501c3 organization in their country? And how do we do that? We want to maintain discretion and control. Legally, you can't just be a conduit that collects a bunch of money and then just gives it to someone else abroad. You have to really control who that money goes to, what it's spent on. Again, there's that front end and back end considerations. On the front end, we want to limit the spending to specific purposes and have an agreement that it's going to be spent for those purposes. And then on the back end, we're going to want reports, receipts, maybe even an audit to make sure that the money was spent appropriately. And in the foreign grant space, there are some additional legal compliance considerations. For example, there is an OFAC list of sanctioned states, entities, and individuals, and we want to check our recipients against that list to make sure that we're not accidentally giving money to sanctioned or prohibited individuals. Okay, the next two topics are a big one, and they're so interesting, and I love them so much. I wish we had more time. We're going to talk about political intervention, and we're going to talk about lobbying. So political intervention. 501c3 nonprofits are strictly prohibited from intervening in any campaign for or against candidates for elective public office. So these are elective public office campaigns at any level, federal, state, local, even international campaigns. And when we say intervening, that can be direct, so that could be donating to a campaign, endorsing a campaign, rating candidates in any way, or it can be indirect. It can be allowing campaigns to access our facilities or resources, use our publications, use our online channels. It could be supporting affiliated PACs or political parties. It could be linking out to these partisan sources in our websites or our email communications. any kind of support. We can think very broadly about what's included in these categories. That being said, there are some election or campaign related activities that are allowed, but they do require extreme caution. So you are allowed to publish, for example, nonpartisan general interest voting guides or hosting nonpartisan candidate forums, but you have to be really, really meticulous in making sure it's inclusive and nonpartisan and objective and blah, blah. You can engage in get out the vote and voter registration activities, again, if they are truly fair and nonpartisan. You can host candidates as speakers in their non-candidate positions, but make sure that they don't stray off script and talk about their political campaigns. And nonprofit personnel in your organization can engage in political intervention kind of off the clock, right? They can do it without any use of or connection to the nonprofit's platforms and resources. They are speaking as private individuals, not in any way affiliated with your nonprofit. So when you're doing any of these activities, just be really, really careful. We have a really great legal alert on the political intervention rules linked on this slide. The next thing we'll talk about is lobbying. So unlike political intervention, nonprofits can do, 501c3 nonprofits can do a limited amount of lobbying. And here I'm defining that as attempts to influence legislation at the high level. We'll get into some more specific definitions in a second. Lobbying can target any legislative body, again, state, local, federal levels, but it must relate to a specific act, bill, resolution, confirmation vote, or similar action or item in that legislative body. It does include budget appropriations and it does include taxes. Lobbying also includes efforts to influence the general public when we're talking about public referenda, ballot initiatives, constitutional amendments, or similar procedures. In those cases, we skip the legislature altogether and go directly to the public. On the other hand, issue advocacy and education campaigns about general societal issues that are unrelated to specific legislation are not lobbying. Neither is advocacy around administrative rules, regulations, and proceedings, judicial proceedings, or advocacy around the interpretation or enforcement of existing laws. We're only talking about pending legislation. So this is a kind of fine line to ride. Again, we have legal guide, webinar on lobbying and also on political intervention rules linked here. But what I want to highlight from that last slide is that nonprofits, 501c3s can do a limited amount of lobbying. You have two options for sort of deciding how much lobbying you're allowed to do. The default option that the IRS uses is a case-by-case facts and circumstances test to determine if lobbying constitutes a quote-unquote significant part of your organization's activities in light of your other activities and expenditures. So under this test, any advocacy by your nonprofit for or against legislation counts as lobbying. And the IRS is kind of like a you know it when you see it kind of thing. The IRS is just going to look at what you do, look at what the lobbying component is, and decide for itself if that's a substantial part of your overall activities. It's a little fuzzy, it's a little unpredictable. With that in mind, Congress created a second option. We call it the 501H expenditure-based test. That focuses solely on the amount of money that you spend on your lobbying activities. So under this option, you get a lobbying budget. For small organizations, it's about 20% of your total expenditures, and you're allowed to spend up to that budget. Under this option, lobbying must include either direct communications with legislators or their staff that expresses a view on legislation, or communications with the public that expresses a view on legislation and also includes a call to action to contact legislators or their staff. So the definition of lobbying is a little bit more narrow under 501H. It's actually a benefit of that test. It has to include contacting legislators either directly or indirectly. So if you want to use 501H, you have to fill out a separate form to opt into that test. Otherwise, you're going to be using the default sort of fuzzy facts and circumstances test. Okay, moving on from lobbying and political intervention, I want to touch quickly just on board stuff. All nonprofits are required to have a board. The board oversees the nonprofit. The board has its own legal fiduciary duty to act competently and to act in the organization's best interests. This is not a presentation about boards, but I felt like I would be remiss not to mention that boards have their own set of legal duties and responsibilities. To connect it to the IRS does see strong board governance and practices as a barrier against non-compliance, especially when it comes to private benefit and private inurement. So I've linked here a little microsite we have all about serving on the board, and I want to highlight a series of webinars that we do called Board Basics that get really into the nuts and bolts of running your board. Taking minutes, managing conflicts of interest, calling meetings, taking votes, having committees, et cetera, et cetera. So a lot of great resources there. Sticking to the idea of the board and going to something that the 990 asks, it's about independent directors. So what I'm talking about when I talk about independent directors are directors that don't have a financial connection to the organization. So you're not compensated as an employee of the organization. You're not a vendor or independent contractor of the organization that receives more than $10,000. You don't receive other material financial benefits from the organization, and you're not related to people who have any of those financial connections above. The best practice is to have at least 50% of your board be independent. That's something that we borrow from the for-profit corporate world. That can be kind of hard for small organizations that are often started by people who have family relationships with each other and perhaps with the organization, but it's a best practice to work towards, and you will eventually be asked to report on the percentage of your board that's independent on your full Form 990. So we have a legal alert on independent directors there. I should also say that just practically, it's a good idea, because if too much of your board has family relationships with each other, that can make managing conflicts of interest really difficult, because that when one person has a conflict of interest, all of their relatives also have a conflict of interest. So that's another reason why it's important to have independent directors. All right, let me talk about nonprofit governance policies. Again, this is something that we see on the 990. The IRS strongly recommends that nonprofits have a conflict of interest policy, a whistleblower policy, a record retention policy, and for those that do joint ventures, a joint venture policy. Also, as we mentioned, there's that safe harbor process for executive compensation. You might want to record how you comply with that process in a policy as well. So focusing on those first three policies, the COI, whistleblower, and record retention, we have a legal alert on each of those policies. And then we also have a separate webinar that discusses them all at a high level. Really, really good practice to at least have those three core policies in your policy portfolio. And then I think this is the last topic here in this section. That's right. We're going to talk about membership organizations really quickly. Your articles of incorporation will tell you whether or not you have what I call capital M members. These are individuals who are not on the board, but who typically elect directors onto the board and also have the right to approve major corporate decisions. Not every member is a capital M member, and nonprofits are not required to have members at all. It's totally optional. And in fact, most nonprofits are non-membership organizations. So if you're unclear about whether or not you're a membership organization, you should check your articles and your bylaws to figure that out. It's important to know because state law imposes a lot of additional requirements when it comes to maintaining and running membership organizations. There's rules around how to keep your membership rolls. There's rules around how to hold your membership meetings. It's a lot more administratively complex to run a membership organization. And because it's more complex, I've seen a lot of nonprofits start as membership organizations and decide at some point it's really not for me, and they sort of just give up on having members. You can't really do that. If you want to transition from a membership to a non-membership organization, you have to update your articles and you have to go by state law requirements to kind of dissolve the membership. It's kind of complicated. And if you want to walk away from it, you should go through that process as early as possible. The biggest headache that I deal with is people who walked away from their membership structures like 10 years ago, and they have no idea who their members are anymore, but they never formally did it. And so now there's a lot of confusion about who the members are, how do we actually become a non-membership organization. So be very intentional and careful around that process of switching between a membership versus non-membership organization. Okay, again, let me do a quick glance for questions that make sense to answer at this point. Again, if not, I might save them to the end or later. Someone asked if DC requires fundraisers to register when we talked about professional fundraisers back in that first section. No, DC does not have a professional fundraiser requirement. What's the definition of smaller organizations for lobbying budget limits? The smallest tier in that category is $500,000 or less in gross expenditures. Those organizations get up to 20% of their expenditures on lobbying, and then you get proportionally less as your budget grows. How do we access the links on the screen? You do that by downloading the PDF version of these slides, either here on GoToWebinar, or for folks listening to the recorded version of this webinar, it'll be linked on the screen where you got the webinar from, and the PDF, the hyperlinks should be live on those versions. Okay. One thing I want to mention really quickly when I'm talking about lobbying and political intervention, there are also lobbying registration requirements in a lot of states, including DC. So if your staff are doing a significant amount of lobbying, you should also look into whether they need to register as lobbyists in the state in which they lobby. Kind of something that wasn't in the scope of my slides, but that I'm thinking about mentioning now. Okay. Let's go to that final section. We're actually doing okay on time. I feel good about this. We're going to talk about filing and other government registration requirements. This is sort of the drier stuff, but really, really important. So the first thing we'll mention is about maintaining your domestic corporate registration. All 501c3 nonprofits are corporate entities. They are incorporated at the state or district level. Every state has its own filing requirements for how to maintain that corporate entity. For example, in DC, you have to file a form every 2 years, basically telling the DC government that you still exist, and here's your contact info, blah, blah, blah. So just the tip here is to check that your corporation is in good standing with respect to its corporate registration, and to make sure to keep up to date on whatever those corporate filing requirements are. Now, that's about operating domestically in your state of incorporation. If you start doing business in other states, you'll need to register as a foreign corporation in each of those states. This term is very confusing because people sometimes think foreign corporation means outside the US, but in this case, each state we're treating as a little country, and foreign means a corporation of one state operating in another. All states have different thresholds for when you've developed enough of a nexus to that state to require you to register as a foreign corporation, but generally speaking, common factors can include owning or leasing office space or facilities in a state, so really having a physical footprint. It can involve employing individuals who work in that state. A little complicated in our remote work world, but still an important factor. And or having kind of an ongoing presence in that state, regular programs, services, activities. So if you have that sort of substantial connection to a state, you might be required to register as a foreign corporation. Not super complicated in most states. It's usually filling out a form and attaching some documents. So not overwhelming, but something to definitely keep an eye on. I want to contrast that with charitable solicitation registration. So separate from registering to do business in a state, around 40 states, over 40 states, have an additional requirement that applies to nonprofits who fundraise in their state. Just fundraising in a state is usually not enough to require you to register as a foreign corporation, but states have created an additional licensing or registration process for folks who want to fundraise in their state. So these states require nonprofits to apply for what we call a charitable solicitation license or registration in order to conduct their fundraising operations. Again, this is a state-by-state issue, so it's kind of a mess. It's super complicated. But generally, if we're soliciting contributions in person, over the phone, using the mail, over the TV or radio airwaves, or submitting grant applications in a state, that usually triggers the requirement to register in the state. Many states have exceptions for organizations that are really small, or for organizations that fundraise below a certain threshold in the state. So that's something to think about as you're deciding whether or not you need to register. And then the big gray area in all of this is that all these regulations were made before the internet, and so they don't often squarely address what to do about online fundraising. At a high level, a lot of like some passive online donations that people just find your donate button on your website and give you money, and it's sporadic and you just get a handful of those, that usually doesn't require you to fundraise, to register and get a charitable solicitation license in the state where those donors live. But resoliciting the residents in that state who, clicked on your donate now button, or receiving just a large amount or volume of online donations from a state may trigger a need to register, even though those transactions were all online. So kind of a gray area. Fortunately, we have a legal alert, we have a webinar, especially on those DMV requirements. I also want to note that DC, of all the states, does charitable solicitation a little weirdly. We make the charitable solicitation license a form of a business license, and you get it through DCRA's regular business licensing process. So whereas in a lot of other states, the charitable solicitation license is sort of its own thing and usually has a kind of simple, streamlined application process. In DC, you have to get a whole business license in order to get a charitable solicitation license. So it's a bit of a pain. It's a little expensive. The bright side is that you don't need to get the DC charitable solicitation license until your nonprofit has raised $25,000 or more in a calendar year in gross receipts. So if you're a really, really small organization, you don't have to worry about it. Okay, let's talk about state tax exemptions. So being a 501c3 nonprofit means that you're automatically exempt from paying federal income tax. However, some additional filings or steps may be required for you to become exempt from paying state taxes in your home state. So we're talking about income or franchise taxes, we're talking about sales or use tax, we're talking about personal property tax. For example, in DC, nonprofits have to apply to the DC Office of Tax and Revenue in order to be exempt from those 3 kinds of taxes above. And you have to renew that exemption certificate every 5 years. I'll note that renewal requirement is relatively new. It was created in 2019. Before then, you never had to renew it. It was kind of a one-time thing. So a lot of DC organizations unknowingly have expired tax exemption certificates, and they should be looking into getting those renewed. Just a note about state taxes. State income taxes may apply to income that was subject to UBIT. So remember from section 2, if you have unrelated business income, you're selling those t-shirts or whatever, you still might have to pay income tax on that. And also talking about the sales tax exemption, if you have that exemption, it means that your nonprofit doesn't have to pay sales tax when it buys stuff that would usually be subject to sales tax. But if you're selling stuff to other people, you might still be responsible for collecting and remitting sales tax on those items. So just something to sort of flag if that's part of your activities. Okay, second to last topic, really exciting. Let me talk about the IRS Form 990. So we've been talking about a lot of state stuff. Let's go back up to the federal level, to the IRS. The Form 990 is the annual information return that nonprofits file with the IRS. A lot of people call this a tax return, but since you don't file tax, since you don't pay taxes, it's more accurate to call it an information return. There are 3 versions of the form that you can fill out depending on your gross receipts. There is the full Form 990 for those who make more than $200,000. There's the 990 EZ for those who make less than $200,000. And then there's the 990N, or the 990N postcard, the IRS calls it. That's for really small organizations that make less than $50,000. Whatever version of the 990 you fill out, it's due the 15th day of the 5th month following the end of your organization's tax year. For those folks who have a calendar tax year, for example, that's around May 15th every year. Nowadays, they're all filed online. You can request an extension ahead of time, but if your 990 or 990 EZ is late, there are daily late fees that are assessed, and the late fees can get pretty expensive. So we want to make sure that we're filing these 990s on time. If you're a 990N filer, you get a little bit of you get some leeway with the late fees. You don't have to pay late fees if you're late. If you miss 3 990s in a row, your 501c3 status is automatically revoked, which is a huge headache. Reinstating your 501c3 status is complicated and costly. It's akin to the process of filing your original 1023 application. and you might actually have to provide even more information explaining why you let your status get revoked. The kind of practice point that I want to note here is that there is a significant increase in the amount of reporting and the complexity of the data that you have to provide between the three form types. The 990N, you don't provide any financial information. You just check a box saying that you make under $50,000 and you're good. The 990EZ, you have to provide basically a balance sheet, more detailed financial information. And then once you get up to the full form 990, it's actually a very comprehensive form that asks for a lot of financial and operational information about your nonprofit. So I always tell people to plan ahead, you know, especially in those years where you're upgrading from one version of the form to the other. Take a look at what the new form is going to require and make sure that your accounting practices are in line and that you have the information that you're going to need to fill out that form. It's a lot easier to plan ahead than to sort of retroactively try to piece together the information after the fact. Okay, I'll just click through everything here. This is our last topic. It's a weird one actually, and it's gonna be talking about public inspection requirements. So there's a kind of esoteric IRS rule that requires you to make 3 key documents available for public inspection. Those documents are your 1023 application for 501c3 status, your IRS Form 990s from the last 3 years, including your Form 99T if you file that. That's the 990 that you file if you have unrelated business income, and all the associated schedules for those 990s, except that you can omit your donor names on Schedule B, and you should omit those donor names under Schedule B. And then finally, your IRS determination letter. So these 3 documents are supposed to be available for public inspection. Now, what you can do is that you can just post these documents on your own website or allow them to be posted on a third-party website. The IRS is actually building out its own 990 database. So eventually we'll just be able to tell people to go to the IRS website for everything. You can also choose to make some or all of these documents available upon request, either in person or via mail or email. This is the best option, especially for your 1023 and determination letters. Most nonprofits do not just put those documents on their website. They keep them as a request only kind of document. Even for the stuff that you make available online, like your 990s, the public always has the right to request those documents in person or via written request. And if you do get that kind of request, you have to respond. You either have to send them the documents or give them the documents, or you have to give them instructions on where to find them online. So this is a training point for your staff and for leaders for your nonprofit. If someone comes in off the street and asks for your 990s, you have to give them your 990s. You can't just like ignore them or tell them to go away. If you're missing any of these documents, the IRS has forms that you can file to request new copies. And the interesting point here is that there are actually daily fines for non-compliance with these public inspection requirements. I have seen some particularly savvy trolls kind of harass nonprofits almost with these document requests. And if the nonprofit's not being careful, if it doesn't know that this is a legal requirement, it can result in some weirdly significant financial penalties. So I wanted to flag that as something that people should know about. Again, we have a legal alert on and webinar on these public inspection rules. A few slides ago, we also had a legal alert on record retention policies. It's kind of a separate issue, but you should have a policy at your nonprofit for which records you keep, how long you keep them for, and which records you destroy and when, and to kind of be consistent about those practices over time. That was our last topic. Woo-wee. Okay, so here is my email address. Here is the link to our entire sort of nonprofit resource library. It also has a listing to our upcoming events, so you can use that as a resource. Let me again do a scan of our questions, see what makes sense to answer now in the kind of few minutes that we have. And then if I don't get to your question, again, please just reach out or look at some of the resources that we have linked in the presentation. Let's see here. Okay, so great question. If we are headquartered, this is about charitable solicitation. We talked about that a little while ago. If you're headquartered in one state but have events in another state and those events generate income, you have to apply for charitable solicitation licenses in that state. Again, it's a state-by-state determination. Every state defines for itself what activities trigger the registration requirement. But yes, in a lot of states, generating program service-related income could count as charitable solicitation, or it just might create, kind of practically, it might create enough of a gray area that your best bet would be to register in that state. Does DC charitable registration include receiving money from DC foundations? It does include requesting money from DC foundations. So asking foundations for money or filling out grant applications in DC and in a lot of other states is a form of charitable solicitation that does require you to register. Someone's asking, they can't download the slides. Will we be emailing them out? Yes, we will be emailing them out. Can I share the recording with members of my board? Absolutely. How do we account for gifts that come with donations, i.e. a suggested donation for a t-shirt or other knickknack? A great and very interesting question. If you are, so this goes back to our quid pro quo discussion from earlier. Someone is receiving something of value in return for their donation. You have to tell people the fair market value of the thing that they got, because the value of that t-shirt needs to be deducted from the value of their donation when they go to seek, if they go to seek a tax deduction for that donation. Now, practically, side note, a lot of people don't itemize their taxes and will not actually seek a deduction for a lot of their donations, but it's still a good universal practice to have for you to provide these acknowledgement letters. And again, for some quid pro quo donations, you're legally required to. So give them the acknowledgement letter, disclose the fair market value of the gift or whatever they received in return. There is an exception for really, really de minimis gifts, like stickers or keychains. There's like a little formula that I don't remember off the top of my head for deciding if something is so low value that you don't have to worry about it. Go check out our legal alert to learn about that exception. Okay, great. Okay, and just let me do one more kind of procedural question. How do we get a copy of this video? Again, we're going to post this webinar on our website, and all the attendees are going to receive an email notifying them when the video is available, and we'll include a copy of the slides in that email as well. All right, I'm over time. It was a pleasure speaking to all of you today. I hope that this presentation left you with more questions than answers. That is fully the point. I want people to sort of, there's that whole known unknowns thing. I kind of want you to know where you might want to do some more reading and some more education, ask more questions, and seek out more resources. That's what we're here for. All right, thanks everyone. Apologies to the folks whose questions I didn't get to. Please hit me up offline. Enjoy the rest of your day. Bye everyone.